Morgan, what we have from United Airlines and the guidance is really what we're going to be focused on. But let's start first off with the results from the first quarter. This was a beat, 91 cents a share. The street expecting 76 cents a share. Revenue coming in at $13.21 billion, just a smidge shy of analyst estimates at $13.26 billion. The pre-tax margin of 3%. You got free cash flow at $2.312 billion and revenue per seat mile up 5% year over year. Those numbers are going to be strong. And in addition, when you look at the revenue from the first quarter by each segment, domestic up 3.9% or negative 3.9%, excuse me. International revenue up 5.2%, premium up 9.2%, basic economy up 7.6%. With the exception of domestic, generally speaking, they're seeing the demand come through in the first quarter. But it's the guidance. This is what people are going to be focused on. In the second quarter, United expects to earn $3.25 to $4.25 a share. The estimate is for $3.93. They are also going to be cutting their capacity by 4% compared to their original plan, and that will start in the third quarter, likely goes into the fourth quarter. It's a little bit vague on that guidance there. And then the full year guidance, I'm not sure how much this is going to please investors. They're giving two sets of guidance. If the economy stays stable and is what it is right now, over the rest of this year, well, they expect to earn what they originally put down as their guidance of $11.50 to $13.50 a share. But United says if there is a recession, and recession is the word they use, they are then forecasting to earn $7 to $9 a share. So what you've got is a really wide range, Morgan, between it could be really bad, or if the economy's normal, we stick with our $11.50 to $13.50. Don't forget, we're going to be talking with United CEO Scott Kirby tomorrow morning on Squawk Box. Do not want to miss what he has to say. And again, the focus here is all about what they're seeing in terms of bookings, not only here in the second quarter, but as you move out through the rest of the year.
Okay, Phil LeBeau, thank you. Those shares are up 3% right now. Jeffrey Kleintop, I want to get to you, and not so much to react to these results specifically, but the fact that I think about Larry Fink from BlackRock addressing the public last week and saying, hey, we may already be in a recession based on some of the conversations I've had with certain CEOs, and pointing to the airlines specifically to say they're the canaries in the coal mines. To see two different sets of guidance here, do you expect we're going to see more of that level? I can't remember seeing that before, but that level of uncertainty as this earnings season plays out.
Yeah, so this week may mark a temporary ceasefire in the trade war, but the earnings reports and the guidance may reveal the early damage here. Analysts have been cutting their earnings outlook for S&P 500 companies this week, but now it's spreading to Europe and other places as well. Today's quarterly update from European luxury goods maker LVMH revealed weaker than expected sales. Some of that was China, but some of that was the U.S., and the stock tumbled on that news. I think we're going to hear more about this. We know that there have been a lot of travel cancellations, particularly from Canadians as they look to travel to the U.S., maybe the sort of a little bit of a mini boycott there on travel and transportation, and that's showing up here in the numbers Phil just talked about, or the guidance Phil just talked about. But looking out, this is what we're into now. It's a ceasefire in the trade war, but it's just the beginning of seeing the damage to earnings. And I think it could be far worse for companies, and maybe giving that guidance in too wide ranges is, yeah, I would say not going to satisfy a lot of investors.